Welcome to Trade Savvy Academy, your go-to channel for mastering your money and building wealth. Today, we're diving into an exciting topic: how to manage your $100,000. Whether you've just inherited a windfall, sold a business, or saved up this impressive sum, congratulations! You're in a fantastic position to grow your wealth. But with great opportunity comes great responsibility. Managing $100,000 wisely requires a clear strategy, and that's exactly what we're breaking down today. We'll explore different scenarios, investment options, sample portfolios, their benefits, risks, and how to allocate your money for maximum growth. From dividend stocks, bonds, growth stocks, to REITs, we've got you covered with practical tips to secure your financial future. If you find this content valuable, don't forget to hit that like button and subscribe to Trade Savvy Academy for more wealth-building strategies. Let's get started. First, let's set the stage. You've got $100,000, and the goal is to make it work for you, whether that's generating passive income, growing it for retirement, or funding a big life goal like buying a home or starting a business. The key is diversification, spreading your money across different asset classes to balance risk and reward. Before we dive into specific investments, let's consider a few scenarios based on your financial goals and risk tolerance. Are you a young professional aiming for long-term growth? A retiree looking for steady income? Or someone in between, balancing growth and security? Each scenario calls for a different approach, and we'll tailor our strategy accordingly. Let's start with the conservative investor. If you're risk-averse, maybe you're nearing retirement or just want to protect your capital, your focus is on safety and steady income. A conservative allocation might look like this: 50% in fixed income options like bonds or CDs, known as certificate of deposits, 30% in dividend-paying stocks, and 20% in real estate investment trusts, or REITs. Fixed income options like treasury bonds or high-yield savings accounts offer stability. For example, a 10-year treasury note might yield around 3 to 4% annually, providing predictable returns with minimal risk. However, inflation can erode your purchasing power over time, so you're not aiming for massive growth here. The trade-off is security. Your $50,000 in bonds could generate $1,500 to $2,000 a year in interest, but you're not keeping up with market growth. Stick around. We will later go over sample portfolios of different types of investors. Now, let's talk about the moderate investor. You're okay with some risk but want a balance between growth and stability. Maybe you're in your 30s or 40s with a decade or two before retirement. A balanced allocation could be 40% in stocks, 30% in bonds, 20% in REITs, and 10% in cash or alternative investments like gold. Stocks are the growth engine here. The S&P 500 has historically returned about 7 to 10% annually after inflation, so your $40,000 in a diversified stock portfolio could grow to $80,000 to $100,000 in 10 years, assuming a 7% average return. But stocks are volatile. Market dips like we saw in 2020 or 2022 can sting. To mitigate this, focus on quality companies with strong fundamentals, like those in the S&P 500 or blue-chip dividend stocks. We'll dive deeper into dividend stocks later, but for now, know that this allocation balances growth with a safety net. For the aggressive investor, maybe you're young, with a high risk tolerance and a long time horizon. Your focus is growth. You might allocate 60% to stocks, 20% to REITs, 10% to bonds, and 10% to speculative investments like growth stocks or even crypto. With $60,000 in stocks, you're betting on higher returns, potentially 8 to 12% annually, though with bigger swings. For example, tech-heavy ETFs like the Invesco QQQ have delivered 15% plus annual returns over the past decade, but they crashed nearly 30% in 2022. Your $60,000 could grow to $150,000 to $200,000 in 15 years. But you need the stomach for volatility. This approach maximizes long-term growth, but requires patience and discipline. No matter your risk tolerance, diversification is key. Don't put all your eggs in one basket. If you're finding this breakdown helpful, smash that like button and subscribe to Trade Savvy Academy for more actionable advice. Now, Let's dive into specific investment options, starting with dividend stocks. These are shares of companies that pay regular dividends, cash payments to shareholders, typically quarterly. Dividend stocks are perfect for generating passive income while still offering growth potential. Think of blue-chip companies like Procter & Gamble, Coca-Cola, or Johnson & Johnson. These firms have a history of stable earnings and consistent dividend increases, often called dividend aristocrats. A stock like Procter & Gamble might yield 2 to 3%, meaning your $30,000 investment could generate $600 to $900 a year in dividends, paid directly to your account. Plus, these stocks often appreciate over time, boosting your total return. For example, a $30,000 investment in a dividend ETF, like the Vanguard Dividend Appreciation ETF, VIG, could grow to $50,000 to $60,000 in 10 years, assuming 6 to 8% total returns, dividends plus price appreciation. The benefits of dividend stocks are clear: steady income, lower volatility than growth stocks, and the power of reinvesting dividends to compound your returns. If you reinvest that $600 to $900 annually, your portfolio could grow significantly faster. However, there are risks. Companies can cut dividends during tough times, as we saw with some firms in 2020. To minimize this, stick to companies with low payout ratios, ideally under 60%, meaning they're not paying out too much of their earnings. Also, diversify across sectors like consumer goods, healthcare, and utilities to avoid overexposure to one industry. A good rule of thumb? Allocate 20 to 30% of your $100,000, $20,000 to $30,000, to dividend stocks for a balance of income and growth. Next, let's talk about real estate investment trusts, or REITs. These are companies that own or finance income-producing real estate, like office buildings, malls, or apartments. REITs trade like stocks on major exchanges, making them an easy way to invest in real estate without buying property directly. By law, REITs must pay out at least 90% of their taxable income as dividends, so they often offer high yields, typically 3 to 6%. For example, a REIT like Realty Income, known as the Monthly Dividend Company, might yield 4 to 5%. If you invest $20,000 in a REIT portfolio, you could earn $800 to $1,200 a year in dividends, paid monthly, which is great for cash flow. The benefits of REITs include high income, diversification from stocks and bonds, and exposure to real estate's long-term growth. Historically, REITs have delivered 8 to 10% annual returns, combining dividends and price appreciation. Your $20,000 could grow to $40,000 to $50,000 in 10 years. But there are risks. REITs are sensitive to interest rate hikes, which can lower their share prices, as we saw in 2022 when rates rose. They're also tied to real estate market cycles. Retail REITs struggled during the pandemic, for example. To manage risk, diversify across REIT types, like residential, healthcare, or industrial, and stick to well-managed REITs with strong balance sheets. Allocate 10 to 20% of your $100,000, roughly $10,000 to $20,000, to REITs for income and diversification. If this is resonating with you, hit that like button and subscribe to Trade Savvy Academy for more wealth-building strategies. Now, let's talk allocation and expected returns. Here's a sample portfolio for a moderate investor with $100,000. 40%, $40,000 in stocks, including 20%, $20,000 in dividend stocks, and 20%, $20,000 in broad market ETFs like the SPDR, S&P 500 ETF, SPY. 30%, $30,000 in bonds, split between treasury bonds and corporate bonds for a 3 to 4% yield. 20%, $20,000 in REITs for 4 to 5% dividends, and 10%, $10,000 in cash or a high-yield savings account earning 4 to 5%. Let's project returns. Stocks might return 7 to 10% annually, so $40,000 could grow to $80,000 to $100,000 in 10 years. Bonds could generate $900 to $1,200 a year in interest. REITs could add $800 to $1,200 in dividends annually, with potential for $40,000 to $50,000 in 10 years. Cash provides liquidity and earns $400 to $500 a year. Total portfolio value in 10 years? Potentially $150,000 to $180,000, assuming 6 to 8% average annual returns. Over 20 years, you could be looking at $250,000 to $300,000, thanks to compounding. Long-term growth comes from staying disciplined and reinvesting dividends and interest. Compounding is your best friend. Those small dividends add up over time, but risks remain. Market crashes, inflation, or unexpected expenses can derail your plan. To protect yourself, keep 6 to 12 months of expenses in cash, part of that 10% allocation, and rebalance your portfolio annually to maintain your target allocation. For example, if stocks surge and become 50% of your portfolio, sell some to buy more bonds or REITs. This keeps your risk in check. Let's wrap up with some key investment tips. First, prioritize low-cost investments. ETFs like VIG or SPY have expense ratios under 0.1%, saving you thousands over time. Second, do your research. Use tools like Morningstar or Yahoo Finance to check a stock or REIT's fundamentals, like debt levels or dividend history. Third, consider tax-advantaged accounts like an IRA or 401k to shield your gains from taxes. Fourth, avoid chasing hot trends. Meme stocks or crypto might tempt you, but they're high risk. Stick to diversified, quality investments. Finally, be patient. Wealth building is a marathon, not a sprint. A $100,000 portfolio with disciplined investing can set you up for financial freedom. Before we go, here's your bonus tip. Consider dollar-cost averaging to reduce risk. Instead of investing your $100,000 all at once, spread it out over 6 to 12 months. For example, invest $8,000 to $10,000 monthly into your chosen assets. This smooths out market volatility and reduces the chance of buying at a peak. It's a simple way to ease into the market with confidence. That's it for today's deep dive into managing your $100,000. We've covered scenarios, investment options like dividend stocks and REITs, allocation strategies, and tips for long-term growth. If you found this valuable, give us a like, hit that subscribe button, and ring the bell for more content from Trade Savvy Academy. Drop a comment below with your questions or share how you're managing your money. Until next time, stay savvy and keep building your wealth.